Welcome to class number 15, folks. Our first of many classes on investing. Some people get anxious, confused, or even frightened when they hear about investing. Others may have a basic comfort level, but are missing a lot of background to help them make the right choices to build wealth. We're going to build a solid foundation of investing knowledge in a way that's clear and honest. It's unfortunate, but there are a lot of people out there pushing inaccurate information for their own agendas. They'd rather confuse you or sell you on some idea to support their own selfish interest. We challenge these folks by informing and empowering you. We're going to lead off our discussion by explaining and comparing different types of investments that you may come across. In this class, we're going to explain equity investments, or what you may think of as stocks. And in next class, we'll talk more about debt investments, also known as bonds. Let's go. When we talk about investments, we often hear the term investment security. Do you mean keeping our investments safe? No, we'll cover that kind of security later. An investment security or security is just a term to describe various kinds of investments and may include equity investments like stocks and debt investments like bonds. An equity investment represents an ownership interest in a company. That is, I own an interest or percentage of the company. Whereas a debt investment represents a credit interest in a company. That is, I loaned money to the company and they owe that money back to me. Let's start off with equity securities. Remember that equation we learned in class number 2? Assets minus liabilities equals net worth. That equation is used to measure the net worth of an individual. But what if we wanted to measure what a company is worth? Well, we use a very similar equation, and that's assets minus liabilities equals equity. If the company is a sole proprietorship, that equity is called owner's equity. If it's a partnership, we call it partner's equity. And if it's a corporation, we call it shareholder's equity. Let's focus on the corporation. At a basic level, ownership of a corporation is divided into units called shares, also called stock. The company can issue any amount of shares that it wishes. Many large corporations have issued hundreds of millions or even billions of shares. If shares represent ownership or equity, that means when you buy a share of a company, you are a part owner and you have a piece of the shareholder's equity. Believe it or not, this is a really important thing to keep in the back of your mind, as you'll see in future lessons. Never forget that if you own stocks, you own a piece of those companies, like owning a piece of any other company. These shares represent assets to us personally. Once shares are issued, they can generally be traded. In other words, bought and sold. Normally, shares are either publicly traded or privately traded. Publicly traded shares are bought and sold through an exchange, also called a stock exchange. The exchange just represents a place where buyers and sellers come together. Privately traded shares are bought and sold directly from investor to investor, often using a broker or dealer as an intermediary or go-between. But these are not sold through or listed on an exchange. Most shares of corporations are offered through an exchange. We'll talk more about exchanges versus the over-the-counter or OTC markets later. There are generally two classes of investors, and these classes determine which type of shares are available to purchase. Individuals like you and me who are not in the investing business but are just buying investments for ourselves or maybe our family are called retail investors. On the other hand, organizations such as banks, insurance companies, endowments, and pension funds, which have much larger amounts of money to invest, also called capital, and who invest on behalf of others, are called institutional investors. If you're unsure about which class of investors you fall in, you're almost certainly a retail investor. Individuals generally don't have access to privately traded shares because investments in those companies require a lot more money and research. You may ask how a company goes from being privately held to having shares that are publicly traded on an exchange. The answer to that question is through something called an IPO, or an initial public offering. Generally, as a private company plans to grow, it will need much more money to achieve this growth. The IPO allows companies to raise more money from investors. When a company goes through an IPO, it is sometimes called going public or taking the company public. Not every company that attempts an IPO successfully achieves one. Generally, the company will engage investment banks to act as underwriters. You know, like those fancy Wall Street banks that got bailed out. We'll talk about those later. The investment bank will analyze the private company's financial statements, like its balance sheet and its income statement, and make projections about the future growth of the company. It will then attempt to estimate a value for, also called underwrite, the shares that the company plans to offer to the public. A company can use a group of banks to do this, called a syndicate. Once this value is determined, the investment bank will find a group of institutional investors who agree to purchase the new shares of stock. After these initial investors buy the new shares, then the shares will be listed and allowed to be bought and sold on a stock exchange via the IPO. These initial investors will then sell some of their shares through the exchange, and the stock will continue to be traded. Once retail investors jump in after the IPO, the price of the stock tends to move around very widely, as these investors aren't as experienced and are often driven by emotion. Look at how the price of a stock changes widely on its first day of trading. As we'll learn in future classes, emotion and psychology often drive the price of stocks, and there are many investors who are far from rational. Next, let's cover the two classes of stock. The one you are most familiar with is called common stock. Stock exchanges use ticker symbols to identify common stocks. Ticker symbols for stocks generally take the form of 1 to 4 letter symbols. Some examples include AAPL for Apple Inc., PEP for PepsiCo, BAC for Bank of America Corp., and so on. A ticker symbol is just an easy way to look up and trade a stock. Ticker symbols can change for things like mergers, name changes, etc., but it's fairly rare. Common stock is issued in units called shares. When you buy shares, you are a shareholder and you are entitled to certain rights. You have the right to dividends if they are declared by the company's board of directors. A dividend is an amount of money that the board of directors decides to return to the shareholders. Usually, dividends come from the income that a company decides to return to its owners. When a company earns a profit, it can either reinvest this money back into the company, pay off debt, or return the money back to the shareholders if the company no longer needs that money. There are a few key dates related to dividends that you should know. The first is called the declaration date. This is when a company formally declares that a dividend will be paid. The next is called the ex-dividend date. This is the date that determines which shareholders will be entitled to the dividend. Shareholders who bought the stock on the ex-dividend date or after will generally not be entitled to that dividend. On the other hand, shareholders who bought the stock and still own the stock on the day before the ex-dividend date will generally be entitled to the dividend. There is another type of dividend called a stock dividend, where the company rewards shareholders with more shares of stock. Common stockholders also have the right to vote on corporate actions, such as mergers or the combining of one company with another company, divestitures, or selling off a portion of the company, and acquisitions, like buying another company or another company's business unit. It's also fairly obvious, but as a shareholder, you have the right to sell your shares to another investor. When you sell your shares for a higher price than what you bought them for, you have something called a capital gain. And if you sell them for a lower price than what you bought them for, you have a capital loss. As such, there are only two ways to make money in stocks: sell your shares for a gain or receive a dividend. When the price per share of a stock is too high or too low, as determined by the board of directors, the company can do a stock split or a reverse stock split. A stock split is done to lower the price of a stock. For instance, let's say a stock is trading at $1,000 a share, and the board of directors wants to lower the share price. They can declare a stock split. In this example, let's assume the board of directors approves a 10-for-1 stock split. Every share that someone owns will be converted to 10 shares. The price per share will drop from $1,000 to $100 automatically. Stock splits don't affect how much stock an investor owns, since $1,000 times one share is the same amount of value as $100 times 10 shares. Stock splits tend to favor smaller investors who might not have enough money to purchase shares at the higher price. On the other hand, if the price of a stock is too low, the board of directors can elect to do a reverse stock split. In this example, let's assume a stock was only trading for $1 per share, and the board of directors voted to do a 1-for-10 reverse stock split. The price of each share will jump to $10 per share, but for every 10 shares someone owns, they will now only have 1 share. You might ask, what if I only owned 9 shares? Well, in this case, you'd likely be cashed out for those 9 shares. Another class of shares other than common shares is called preferred shares. It's very rare that retail investors will own preferred shares directly, but they can be purchased, so we'll cover these briefly. Preferred shareholders have a dividend priority over common shareholders, but they generally don't have a voting interest. In the event of a bankruptcy of the company, preferred shareholders will have their investment returned before common shareholders, assuming there is enough money to distribute to them. Most preferred shares are traded on stock exchanges just like common shares. We'll talk a whole lot more about stocks as we dig deeper into investing, but I hope this class gives you a solid foundation on what they are, how they work, what benefits they bring, and what types there are. In our next class, we'll do the same, but for bonds, also called debt investments. See you next time. If you have any questions at all, I encourage you to contact me at opusmonetaquestions@gmail.com or comment below, and I will try my best to get back to you as soon as I can. Thanks for watching. If you found this content to be helpful, I'd like to invite you to hit the subscribe button and give us a like. You can also find additional resources, insights, and motivation by following us on Instagram and TikTok. Also, we greatly appreciate your recommendations. If you think this content may help your friends and family, share the wealth and let them know about us. See you all in class number 16. Peace!